Have you ever watched a tax dispute unfold over years with shareholder loans, payroll routed through a related company, and even a TV production payment all weaving into one story? Yes, this is the journey of Patrick Gabriel before the Tax Court of Canada in 2024. Hi, I'm Amandeep Singh, CPA from Cloudiverse CPAs in Burnaby. Let's walk through what the court looked at, why the numbers mattered, and how careful documentations shaped the final outcome. Patrick ran Life Breath Home Care Services. Many bills, payroll runs, and contractor payments flowed through a related company, Park Home Furniture, because Life Breath lacked checking privileges. That choice created a trail where expenses for two companies appeared on one bank account. When CRA audited, they leaned on the year end due to shareholder balances and said LifeBreath conferred shareholder benefits of $157,000 in 2010 and $51,000 in 2011. CRA also raised two more items, 12,000 T4A and 3,500 real estate commissions plus gross negligence penalties. Inside the courtroom, one simple idea guided the judge's approach. Accounting entries reflect reality. Entries do not create it. So the court focused on verified concrete movements of value. The judge dug into CRA's working papers, every transfer, every loan back from EconoRent, which was Patrick's solo proprietorship, and every mortgage payment of $1,000 that LifeBreath made towards a house for Patrick's former spouse. Two pivotal fact threads shaped the result. First, the building letter of credit. In December 2010, $17,500 left LifeBreath's account and immediately went back into a GIC to secure a municipal line of credit. CRA treated that as a personal benefit. The judge viewed the sequence. Fund cycled right back for corporate security. That movement served the business, so it stayed out of shareholder benefit territory. Second, the flow between shareholder and company over 2 years. When the court totaled verified debits and credits for 2010 and 2011, the credits into LifeBreath exceeded the debits out by roughly $23,740. In plain language, Patrick's side put more into the company than it drew. Under the court's approach, a benefit emerges when the shareholder accounts drifts into deficits or value shifts personally. The verified math told a different story. Now, the 12,000 T4A. During the case, memories evolved about who issued it. First a film production, then Park Furniture. Once the slip surfaced, the paperwork aligned with Patrick's 2010 return. The $12,000 already sat in his filed figures. The $6,000 of tax withheld. With the alignment in place, the court set the $12,000 issue aside. The real estate commissions of $3,543 followed a different path. Patrick earned a commission and then gifted the net to an employee as support. Generous, yes? Yet commission income arises when earned. The gift came after. The court capped the $3,543 in income for 2010. And what about the penalties? CRA assessed gross negligence penalties under subsection 163. The judge looked at intent and behavior. The evidence showed effort, confusion, and unconventional systems rather than deliberate misreporting. The court cancelled the penalties for both 2010 and 2011. Now, step back and see the through line. The audit relied on year-end shareholder loan balances that bundled amounts owed to Patrick together with amounts arguably owed to Park Furniture. The courts preferred verified movement of value across the years. Mortgage payments, repayments to TD Bank, wages reclassified at year-end, and deposits flowing in from Econo. That granular ledger detail carried more weight than a single blended balance figure. One more plot point: the hinges from a dissolved medical device company. Patrick said he received $300,000 of inventory and sold it to Life Breath on account, increasing what the company owed him. The records around that were patchy due to lost data and time. Even with gaps, the court kept returning to the same compass. Just identify the transactions that survive on paper, bank lines, slips, and payroll runs, and compute from there. The final picture: the court removed the $157,000 and $51,000 shareholder benefit inclusions, confirmed that the $12,000 T4A sat aside the filed return with withholding credit, kept the $3,543 in commission as income, and cancelled gross negligence penalties. You see, the results for both years moved accordingly. Here's the practical takeaway for business owners and directors. Shareholders' loan accounts deserve discipline. Separate due to shareholder from due to related party. Keep payroll flows clean when one entity pays on behalf of the other. Preserve the proper trail. Bank statements, payroll registers, T4, T4A summaries, and any security related instruments like GICs, pledge for letters of credit. When the numbers line up with documents, the story carries real strength. At Cloudiverse CPAs in Burnaby, we guide clients through these crossroads like Google Maps for income tax, clarifying rules for shareholder loans, related party payments, and audit-ready records so your facts speak clearly from day one. I'm Amandeep Singh. Thanks for watching, and I'll see you in my next video. Until then, bye.